tribunal have gone through or referred to very old but very effective decision which was of Supreme Court, where the matter was on allied laws. So it was not on income tax laws, but in the allied laws they had referred that all the legal heirs who are on record should be made should be affected by this particular any of the litigation matters. So Supreme Court had ruled in that particular decision where they said that all the legal heirs who are on record should be brought out as a part of the appeal matters, and they should be all should be getting affected. So relying on the same principles, tribunal also said the same format that since the assessing officer is aware about 7 legal heirs who are there on record, because there was a succession certificate which was already issued. So since the succession certificate was referring to 7 legal heirs, tribunal ruled that the reassessment proceeding should be on all the legal heirs and not only on the 3 legal heirs. So that is what is the outcome of this particular decision. This is why my point, why I have brought this thing, is because I have seen a lot of a lot of pointers which will come now, because unfortunately due to corona a lot of families have got affected, and therefore this decision would be relevant for them. So that's the only reason I have brought this particular decision over here. The second one was about the faceless appeals. So here what had happened is, in this case law which was there before Agra Tribunal, the matter was about employees' contribution for PF and ESIC. Now, the matter was whether there should be a disallowance under Section 43B. Uh, as we all are aware of, there are diverse view. There are high courts which are in favor, saying that disallowance should not happen as long as the payments have happened till the due date of filing of the return. And there are also the decisions where they have said that no, it should be only till the time of due date, right? So in this particular matter, the CIT appeal took the decision which was against assessee, and he said that because the jurisdictional high court is not relevant for him because it was faceless appeal. The jurisdiction high court is not relevant, and therefore he didn't apply the favorable decision but applied the adverse decision. The finally what was ruled out by the tribunal was that in this particular case where the registered taxpayer is registered, that will be the considered as a jurisdictional high court, and that jurisdictional high court decision will be applicable to that particular assessee. So in our case also, in regular practice, if we belong to a particular region, then that particular region's high court will be made applicable even if it is a
It's five
faceless appeal,
o'clock.
even if it is a faceless appeal. So not necessarily that where the CIT appeal is located, that jurisdictional high court is supposed to be followed. Where the assessee is registered, that will be considered as the jurisdictional high court. So therefore, it is relevant in today's time. Again, this is also very important because there are a lot of 12A renewals which are happening, trust renewals. So in this particular case, what had happened is there was a school and the school had taken a primary registrations and approvals from CBEC, but they were also required to take secondary approvals which were not being taken by them in past. The matter went to commissioner for giving the certificate, exemption certificate. Commissioner denied to give the certificate based on this particular clause. The clause refers that compliance of such requirement of any other law for the time being enforced by the trust or institutions as are material for the purpose of achieving its objective. So it says there should be one compliance of compliance. Compliance should be of other laws, and third, it says that it should be material for the purpose of achieving the objective. Now, in this case, what happened is because the school had taken a primary registration to run the school from CBAC, therefore, school raised an objection that because the primary registration is already taken, they are material for the purpose of achieving the objective, whereas the secondary registrations which are not material for achieving the objective. So the school can run without that also. Commissioner raised an objection saying that no, that is not allowed because you are required to take compliance of all the laws, and therefore he didn't give the registration. Finally, tribunal said that no, it is not right. You need to give the registration because Secondary registrations though are relevant, but it is not material for the purpose of achieving the objective of the trust. So this is very important. Material for the purpose of achieving the objective of the trust. Now, if that is not the case, commissioner can't stop the registration, he should grant the registration. This will be important while we go for renewal process in current time, because there could be some non-compliance which must have happened in past, and the commissioner should not reject those certificate just basis on those non-compliances. Treaty benefit. Now and we are going on to the next but very important case law. Then this case law is in relation to treaties. So income tax. So India has entered into multiple treaties. There is a concept of transparent entity. So what is that concept is where like a partnership firm or an LLP in India. Now what happens is the income is actually in transparent entity format. Income is not taxed to that entity. The tax is actually being paid by the beneficiaries. Now let's take an example where let's say entity is registered in US. The beneficiaries, some of them are registered in US and some of them are registered in, let's say, another country. For the sake of understanding, let us take Germany. Now in US, while they have provided the services to India making a payment to US, be applicable or not, right? This will be a question. And therefore the next question will be that whether which DTA now the question of which DTA to be applied is very important because that will determine the taxability. Now here in this case, what happened is because it was a transparent entity, the question was whether I can apply US DTA because the beneficiaries are not necessarily registered and taxpayer in US. They are a taxpayer of other country like Germany. Said that and therefore the remittances is taxable in India, and you can also pay tax in US if required. But India taxpayers said that because the beneficiaries are registered US to a certain extent, therefore the DD benefit should apply. Court went into an elaborative discussion about it, and they how what is it's very interesting to see what is the ruling of it. The ruling says that so first point what the ruling says is that when we go to OECD, okay, OECD says that in case if suppose the the entity is registered in US, beneficiaries are also registered in US, then the benefit of DTH should be applied because at the end of the day, it is a taxing countries. Two countries are involved. Let's say India and US. Now, question is that in case if the all the beneficiaries are not in US and some of them are in Germany, then what happens? So the ruling says that in such situations, India has to specifically agree with that government and enter into a treaty in such format that it protects such particular beneficiaries' interest. So, if the beneficiary's interest is protected specifically by the agreement, that is DTAA, then in that case, the benefit should be granted. Now, they have referred to or they have cited one example, which is with Netherlands, where they have said that the treaty is very clearly specifying that in case of a transparent entity also, the benefit of DTAA should be available. So since that is specifically mentioned, they said that yes, then the benefit should be granted. So if you refer to this particular statement, this is the statement from that ruling. Both the countries should consider it as transparent entity by express agreement as done between Netherlands and US. So in this treaty, they have specifically agreed that yes, the transparent entity also the benefit should be granted, and in such situation, the benefit should be granted. I'm also referring to one more article, the article number 12. In article number 12 of Indo-Netherlands Treaty, at para 2, the recipient of royalty and fees for technical service, who is also beneficial owner. see refer to, it says who is also beneficial owner, the tax is charged restricted to 10% on the gross amount of royalty and FTS. There is no such similar benefit for beneficiaries or beneficial owner in Article 13 of the taxability of capital gain. So since Article 13 is not specifically providing or protecting the rights for beneficial owner, so that will not be covered. But Article 12 specifically provides, and therefore beneficiaries will all rights are also getting protected. So the outcome of this is that when we make a remittances, we not just need to ensure that the entity is registered in US or not. We also have to ensure whether that particular treaty is protecting transparent entities rights. So like LLP is a transparent entity in a lot of countries. So you need to see while you are making a remittance to while you are making remittance to LLP, whether that treaty can be applied or not applied, whether the treaty is specifically protecting the rights of beneficiaries or not. So that is something which we need to see. Now I'm moving on to the next case. Okay, very important case for all the remittances related to softwares where we make regularly. There are a lot of requests which comes on. Even I am receiving a lot of queries in relation to this transactions of software or digital payments, where what should be the taxability, how the TDS should be applied. That's a very vital point in today's scenario after Supreme Court decision. So engineering analysis is a decision which we all are aware of. And if not, I'll just give you the summary of what the decision is saying. And then we will, of course, go into what should be the taxability for each kind of transaction, right? We'll discuss that also. So what is the outcome or what is the summary of the decision is what I'll brief you over. The decision is summarizing by saying that the test of chargeability is relevant. Of course, when you want to apply 195, what is important is that first it should be chargeable to tax. Second, DTAA benefit refers to royalty means, and therefore it is an exhaustive definition. Okay, because it starts with the word royalty means. Now the income tax definition is wider in the sense. Why we are saying it is wider in the sense? Because it talks about lump sum consideration. That is the first point. The second point, it refers to all or any rights, right? It does not, if you refer to royalty definition, it says under income tax, it says it is lump sum consideration. Second, it says talks about all and any rights. And third is it is in respect of copyright. However, when we refer to definition of DTAA, it is relatively narrower as compared to income tax definition. What the Supreme Court is emphasizing, the Supreme Court is emphasizing on this point that Supreme Court emphasized that the if you consider it royalty, then it should be the licensee should have right and interest in the software. Okay, if he does not have a right and interest in the software, then it is not royalty, what the Supreme Court says. Since right to reproduce is prohibited, it is not a copyright. So if I'm not allowed to reproduce, then it is not a copyright. That is what Supreme Court says. Copyright is an exclusive right, restricts others from doing certain act. So when I make a payment for copyright, it's an exclusive right which is given to me, where I can do a copy, but others are not allowed to copy. That is what the copyright is. And for that, if I'm making a payment, then yes, it is a copyright which I'm buying, right? So that is what Supreme Court had said. Ownership of copyright is different from ownership of material in which copyright is embedded. Are you getting it? It says that ownership of copyright is different. If I'm getting a copyright, so tomorrow if Ashish is giving me a copyright to use certain material, sorry, if he is giving me a copyright to reproduce certain materials and distribute in India, then I am buying copyright. So the payment which I make to him is royalty. But if suppose there is a copyright which already Ashish has, and if he just hand over it me and I utilize it, and I make a payment for utilizing it, then it is basically ownership of material in which copyright is emitted. So I'm having that particular material which I'm going to use. License does not confer interest in software and therefore not royalty. not copyright. Copyright under Section 30 of Copyright Act have very clearly said that the person should have a right and interest in the software. If it is not there, then it is not a copyright according to the Copyright Act. And therefore, if you literally understand this case, then it tries to say that all those license payments which we are making on a daily basis are actually not a payment for royalty. Okay, that is what the outcome of this decision is. But of course, Supreme Court has restricted his ruling only on the shrink web software. They have not elaboratively discussed, sorry, they have not given a ruling on the licensed software or any other kind of software. They have given a ruling on the shrink web software. But yes, these are all the observations and discussions which are there as a part of the decision. Even in case of customized software, the source code is not shared. We all are aware of, right? The source code doesn't get shared, and the sharing is very limited, and therefore complete exploitation of software is not permitted to the licensee. So if you must have come across multiple such software agreements where you are allowed to have certain utilizations of the software, but you're not allowed to they are not sharing you a source code wherein you can do the modification. So in a nutshell, what it tries to say is that unless license is under Section 30 of Copyright Act, which grants interest in transfer and right, it should not be construed as royalty. This is very important statement. Now, let me take you some important pointers. There are SaaS based model, there are platform sharing models, and there are infrastructure sharing models which are there in currently in the digital world. Now, what is SaaS based model? We all are aware of. They share infrastructure, they share platform, and they also share data and applications, the core of the software. Okay, so for example, Taxmin, if we consider, then their research or their decisions compilation is the data which they are sharing with us. So they are sharing infrastructure. We are allowed to do the search and everything in that particular software. A, they are also sharing the platform. To tomorrow, if I want to put something into it and I want it to be reviewed by everybody, I am allowed to do that, and that is what it happens. So point number two, that is platform sharing. Third is basically the data and application is what I'm able to use. Okay. So SaaS model provides all these three things. Now, point is that whether it is an open source code which is available, wherein I have the right to modification. If yes, then okay, I'm making a payment for copyright. But if no, then I'm not making a payment for copyright. What I'm then making a payment for is only to use that particular service, right? I'm not making a payment for copyright. Platform. So what happens in platform? You must have come across where you have the source, you have the platform available. You can do certain activities into it. So you can have your creativities into it, and you develop your own. What you can say, kind of maybe a tool, or if you want to have some analytical tools, you can do that. So there are platforms which are available. Now the question is that whether this platform is made available to me. If I'm having a right to reproduce, then yes, then I can say that I'm making use of that copyright. So that is what the platform sharing model is. We talk about infrastructure. So what happens there is you are given storage, you are giving networking. So you have all the networks which are related to infrastructure is provided to you. You are allowed to use it. Okay. See, just see the wordings. It says, but not a copyright to use equipment as modifications are not allowed. You are not allowed to do modifications in that. Subscription of database. In case of subscription of database, so we have multiple such payments where there is a subscription model. uh, there is a very what I can say, a ruling which is being regularly followed by department, which is VPRO, Karnataka High Court, where they say that because you are using database and infrastructure, even that is considered as copyright, and therefore it is royalty. When we refer to explanation 4, even there they have the explanation very widely covering all kind of licensed softwares. Okay, and therefore department is always of the view that yes, all this kind of a softwares are taxable in India. They don't take the protection of DTAA into consideration, and therefore they try to tax it. Now, Wipro had relied on Samsung's case clause, okay, which was stuck by Supreme Court. Supreme Court had stuck that decision, and therefore one can say that it is then not relevant to apply Wipro in all the cases, and you need to really go into the intent of agreement treaties agreed with the government by the government, and the treaty is protecting all those license payments where you are not allowed to reproduce, but the income tax does not protect. So when it talks about domestic payments, then you can still say that okay, the domestic law is covering such kind of subscription payments, but when you have the benefit of treaty, then one can really argue that in such situation it is not a copyright and therefore no royalty. Okay. Now, of course, now one will come into a situation where if it is not royalty, whether the equalization levy will apply. Yes. So that is one thing which needs to be deliberately taken point as that, yes, in case if it is not royalty, whether I can say that it is online provision of a service and therefore equalization levy applies. Yes. The answer is yes, that in such situations, if you don't consider it to be royalty, then the equalization levy will come into picture. Now, that is basically an arbitrage decision which needs to be taken, that whether I want to avoid litigation and therefore I want to consider it royalty, and therefore the service provider will be able to take the credit of that particular tax which is paid in India, or I don't want to consider it as royalty. I want to be aggressive while taking a decision, and therefore I do not deduct tax at 10%. I will pay equalization levy, and the opposite person will not be able to take the credit of that. Now that is an arbitrary decision which one need to take upon, but yes, that is what the current scenario is. Moving ahead. Now the next point is the onus is upon the assessee. Now, I'm going on to the next case law. The case law is referring to transfer pricing. That under transfer pricing, what happens is while we do the study, while we do a benchmarking exercise, we do the comparison with outside companies, with external companies. And based on certain parameters, we consider it to be a comparable company, and we select it for the purpose of comparison at a PLI level, profit level indicator. Now the question is that whether in such scenario, if I consider one company, let's say X, as comparable, tomorrow if the department is saying that no, it is not comparable, excuse me, this is not comparable. Now I need to go into explain to the officer with all those parameters which I have done in my study, and explain the assessing officer that this is why the reason because of which I am saying it is comparable. Don't misjudge this. This is comparable, but that is something the onus will be on the taxpayer. Department will not be responsible to prove that it is not comparable, right? That is what this decision is trying to say. Again, a relevant case because there have been a lot of queries, a lot of adjustments which has happened on the uh, differences arising in 26 AS. So under 26 AS, if the amounts are not matching, I have seen a lot of adjustments, lot of orders getting passed where those adjustments are done because the income does not match. Here in this case law, and there have been couple of more cases also where the courts have accepted the fact that what needs to be looked into is whether the person has actually earned the income or not. Just because there is a difference in 26 AS and the books of accounts, there should not be an adjustments for that. So there are a couple of rulings beyond this also, but this is the recent one which I came across, and therefore I have brought it on table, that where the difference between the books and 26 says due to wrong data entry or information and lack of corresponding services by the deductor to the deductor, 26 says alone could not lead to addition to an income. That's what this decision is trying to say. Moving on to the next one. registration can't be denied if carrying out the operation outside India. Now, what happened in this case is there were multiple. So the objective of the trust, the trust was formed, and the object of the trust included one clause that they are allowed to open the branches outside India. Now, what the commissioner, while granting the registration, what he took it as that because you are allowed to open the branch, or your objective is to open the branches outside India, therefore you will apply Indian funds overseas, and therefore the registration should not be wanted. Now the court said that no, that's not the situation, because there can be a case where the branch is self-sufficient. They will raise the funds from the local office, like let's say Singapore. So they will raise the funds from there and they will use it for their own operations. It is not necessary that Indian funds will only get diverted to US. Sorry, to Singapore. Therefore, the court said that point number one, at the time of granting the registration, you are not allowed to look into what is going to be the application of funds at the end of the day. What are you going to look into is whether the objective of the trust, which they are quoting into the trust deed, whether it is for the purpose of charitable activity, whether it is defined into the whether it is covered under the definition of charitable activity. That is what you're supposed to look into. That's point number one. Point number two say that is that in case if tomorrow if they are applying Indian funds to overseas, then at the time of assessment you can always raise this particular question and you can consider it at that point of time. It is not necessary to consider it now. And point number three, that because they have very clearly specified, they means the trust. The trustees have clearly specified that opening of the branch, though it's an objective, but application of the funds will not be from India to Singapore. I'm just taking Singapore as an example. No, will not be from India to Singapore. Singapore will be self-sufficient. They will raise the funds from there and they will utilize for the purpose of their objective. It may so happen that the fund may come to India for the utilization. That is also possible. So that's how they got the registration, and finally they gave the registration. Again, why important? Because a lot of renewals are now going to question, if their renewals are getting questioned and if any of the trust has this kind of situation, then they can refer to this case law. Next case is about what will be considered as the date of taxable event. So event of taxing is which date. In this case, what happened is there were two dates. One date was the date on which the agreement was entered, uh, possession was given, payment was made, and the second date was when finally the registration happened and the stamp duty was paid. And coincidentally or unfortunately for the taxpayer, happened to be in two different financial years. Now the question was in which year this should be considered as taxation. Now on what this case law was mainly on the fact of reassessment, because the if I take year one, then the reassessment time limit was time barred, and if I take year two, then the reassessment time bar was available and officer could do the reassessment. So officer said that it should be year two because the registration happened in year two, and the taxpayer said it should be year one because agreement was entered, payment was made, possession was received. So the taxing event is date one and not date two. And court agreed to it, and they said that yes, the taxing event is date one, which is the date when agreement is entered, possession is given, and payments, majority of the payments are made, and registration is just a formality, and that should not be considered as a taxing event, and therefore the reassessment was not allowed. It was considered as time barred. Very interesting case, which is the next one, is partners is allowed to set off the losses of a partnership firm. Now, when I read this case, of course, while I was reading the heading, I found it very interesting. It says partner is allowed to set off the loss of from the partnership firm. When I got into the detail of this case, I realized what it says is that let's say a situation where Ashish, both are entering into a partnership. Initially, our strategy or our format is such that that initially we will require to pump in the funds and we need to burn the cash so that ultimately there will be some business which will be achieved over a period of time in the partnership. Now, because we have introduced capital, Ashish had his own funds, but I borrowed the funds from outside and I introduced into the partnership form. Now, the point is that the interest which I'm going to pay, okay, whether I'll be allowed to claim that as an expenditure and can I set off against other source income? That's a question. The court said that yes, you can do it because ultimately, while you introduce the funds into the capital, into the partnership firm, the objective was to earn income, and anything which you spent for earning an income should be allowed as an expenditure, and therefore that expenditure will be allowed as a business expenditure, and you can of course set off against any other income. So that is what this ruling is trying to say, and that's a very interesting ruling. Again, a very important and very interesting ruling. uh, in this situation, what happened is there was an agricultural land. Okay, I gifted an agricultural land to Ashish. Again, I'm very much in a favorable situation with Ashish right now, so I'm giving a lot of things to Ashish right now. So agricultural land, I gifted it to Ashish, and Ashish, I didn't took any consideration. So whether in the books of Ashish, whether this will be considered as capital, sorry, whether it will be considered as income under section 56 or not, that was a question. Okay, since it is an online format, I'm not raising it in a question format. I'm just going directly to the answer. But the point is whether it will be considered as income because I have not taken any consideration. Now, when the matter went to this question went to Jaipur Tribunal very interestingly made one observation. They said that when you read the definition of capital, sorry, when you read the definition of properties under section 56, it starts with saying property means capital asset, and then each of the points are covered like land, jewelry, and so on and so forth. Therefore, they said the tribunal said that it refers to capital assets. So, what is important is that it should be classified and covered under capital asset. Now, in this case, because agricultural land was situated within the boundaries of municipal area, I'm sorry, because this agricultural land was situated beyond the boundaries of municipal area, therefore it was not considered as capital asset, and therefore it was not taxable in the hands of Ashish because it is beyond the limit of municipal area. It is not a capital asset in the first place, and therefore it is not covered under the definition of property at the second place, and therefore 56 will not apply. That's what the ruling is trying to say. Department is bound to consider request of personal hearing before passing faceless assessment order. Now, there was huge amount of cry which we all did because all the faceless matters which got completed. I don't think I would put it in this way: very small percentage must have got personal hearing, uh, but otherwise, largely none of them have got personal hearing, and the orders have got passed. Even Bombay High Court recently have also ruled that yes, personal hearing should be granted, and just under the coverage of faceless assessment, that particular opportunity or the right which is available with the taxpayer should not be taken away, and therefore the personal hearing request, if it is made by the taxpayer, it should be granted. So that is what even this ruling is trying to say. Delhi High Court have also said the same thing. Even recently Bombay High Court have also ruled in the same format. Limitation period for reassessment to be renewed from the date of issue of the notice and not the date of the service, that we of course all are aware of, that it is date of the issue of the notice and not the date of the service of the notice. So if suppose the date notice is issued, you have come across that particular notice later, then that is a different scenario, but the time limit is already from till the date of issue of the notice. So I think I am, as far as the case laws are concerned, I am done with the important cases which were there in front of me. Now I'll just take you to the circulars which are also going to be relevant and important. Uh, just give me a second. I'll just share the screen of that.
Darshakji, in case any member has doubt, shall we take it right away or post this session?
Both are open for me.
Members, in case any doubts are there, or in case you want to ask the speaker about any matter, you are.
Just give me a second. Is the new screen visible, Ashish? Recent circular?
No, we are able to only see the old screen.
Just give me a minute.
It's visible now.
It's visible? Okay,
Yes.
thanks. Okay. So this is basically a compilation of all the circulars which have come across mostly from January, February till now. Mostly all the circulars is what I have compiled which are relevant. Uh, this first one is basically which had given a relief from GAR from reporting perspective in tax audit. GAR provision is something which has been relieved upon till 22, and the other one which is relieved upon is breakup of expenditure of entity registered and not registered. So that is also something which has been relieved upon. Residential status, I think this is a little old circular, but yes, this was mainly trying to say that in COVID, if somebody has got stuck up in India and because of that his residential status has got triggered, then you can make a reference to through this particular circular to the concerned authorities. There was a specific form provided which you need to give, and then they will take a decision whether the residential status should be extended or not. So that is what the circular was referring to. 15 CB, yes, we are still having a problem with the new online software. So I believe a lot of people, we are still continuing with the manual format. But yes, the circular had actually got extended till 15 July. That was the older one. Now, this 194Q, the circular, what it tries to say is deductor. So as we all are aware of, the provision of 194Q is TDS, which is supposed to be applied while you make a payment for purchases, and 206 provision 206C1H provision is basically on the sale, so TCS on sale, right? So that is what we are aware of. The basic criteria is that the applicability is if it is about 10 crores, and the second criteria is the transaction limit is 50 lakhs. So if it is below both, if it is below that, then the provision does not get triggered. If it is above that, then the provision gets triggered. Basic point. The next one is ideally TDS is supposed to be deducted. So the first obligation is on the purchaser. When he is making a purchase, he is supposed to deduct the TDS, uh, and not the seller. So that is what the ideal position is. But let's say if suppose the seller has already collected the TCS on a transaction, then though the purchaser is under the obligation because the in value terms it is getting triggered, but because TCS is already collected, now the TDS is not required to be deposited. That is what the notifications have very clearly mentioned. Now let me take you to the notification. Notification says introduction of compliance check. So this is where the registration ID is, where you can go register and check. So first, what the format is, that first you need to get it registered with the portal. Once you are registered, you will get a particular code. You need to give that code, and based on that, the portal allows you to upload your file and check whether the compliance. So the provision says that if the opposite party have filed their return on time, then the TDS rate is different. And if they have not filed it, then the rate is different. That we all are aware of. Now, I want to check whether they have filed their returns on time or not. And therefore, this facility is available where you go and register on the portal. Based on that, the portal allows you to access the database, and then you can upload your deductees file with the PAN number on that particular portal. Portal will do the calculation, and they will throw a data which says that okay, how many parties have filed the returns and how many are defaulters. So, and accordingly, your TDS rate can be determined. So that is what the portal is trying to do. Portal also allows to do the processing for bulk data. So if there are multiple deductees, then at one time you can get the report of all the defaulters who are there on the screen. 194Q not applicable in following situation. Transaction relating to securities and commodities, no. Payment to non-resident, no. Transactions either where either payment or credit for the transaction happens before July, no. On GST amount, if GST is separately indicated in the invoice, in case of advance payment, better to identify GST separately. So if the GST is separately identified, then not on GST component. This we spoke. 50 lakhs is to be considered for entire year and not from 1st July. 10 crore is only business turnover or gross receipt from the business activity to be considered. So anything beyond business. So if you have a gross receipts which is from other source, are not related to the business, and that is not supposed to be considered in the calculation of 10 crores. Order for precedence between what is the order between the three sections? So there are three sections. Which one is supposed to be uh, followed first or preferred first? So first is 194O, which is basically tax TDS for e-commerce transaction. So the e-commerce operator is supposed to deduct the TDS. So that is A. B is purchaser and C is seller. So that is the order of preference. But as I told you, if the seller has already collected the TCS, then again the purchaser is not required to deduct the TDS. I think this summarizes what I had to say for this particular circular. Moving on to the next one, new portal of course are having a lot of challenges. We all are facing those challenges, and there are a lot of things which are happening as far as practicing is concerned, where the challenges are being faced. But what the software is or the portal is promising is pre-filled data, online payments through the portal. So you can have RTGS, NEFT, UPI, net banking, all through all this format. You can make the payment directly. User friendly. So mobile application and dashboard. So some of the dashboards are already operative and effective. Some of them are still facing a problem. So yes, that is what it says. You need to your digital signature requires to be re-registered on a new portal and not allowed to have an old registration. So OTP, of course, that is something which we are aware of. This is one circular which was for the internal guidelines of the department, where it says in case of a faceless assessment of scheme, notice shall be issued by the prescribed authority and served by mm, NEAC as per the provisions of faceless scheme. Subsequently, the cases which have been assigned to specific unit in regional office through a automatic allocation system for the purpose of reassessment. So basically, the notice will be issued at a central level, and then there will be a reallocation which will happen internally at the regional level. In case pertaining to central registration, central charge and international taxation, notice shall be issued by the prescribed authority and served on the assessee electronically. Subsequently, these cases have been directly displayed to the jurisdictional assessing officer for carrying out the assessment further. So that will not be regionally distributed. That will be taken care of by the jurisdictional AO. Service of notice in case of selection of scrutiny has to be made by transmitting the authenticated copies of notice on the e-filing account or email ID of the assessee as prescribed. Verification module provides access to different types of cases that are generated on the basis of approved rules and assigned to a designated user. Details of cases selected under CAS are available under the case under 143.2. So the verification unit, so what will happen, the structure, what they're trying to do is that, let's say, for example, Ashish is into a verification unit. I am a officer who is going to review it. So basically, Ashish dashboard or his login will reflect the cases which he is supposed to handle, and my dashboard and my login will reflect the cases which I am supposed to handle. What am I supposed to do is something which I'll get reflected on my dashboard. I will do the assessment and hand over back to the central unit. Central unit may allocate it for re-verification to Ashish, with Ashish will be able to know when he gets into a login of that. So that's the corporate allocation mechanism which is going to be applied even over here. Access to taxpayers profile view of inside portal. So the assessing officer will be able to review following informations on the portal of his login. So Ashish will be able to review taxpayers comparative ITR information. So maybe 3 years information he will be able to review. Key values ratios will be reflected. Some information about the assessee will be available. List of accounts, immovable assets will be available. Key list of key persons, shareholders, their relationship will be reflected. So all these informations will be reflected on the dashboard while Ashish, as an assessing officer, does the login of the assessee, which is he is supposed to do the assessment, right? So this is what the circular was there mainly for internal guidelines on how the reassessment proceedings, sorry, how the faceless assessment proceedings are supposed to be handled. It's an old circular. I believe this is now been taken care of and into the knowledge of everybody, but I'll just summarize it. What it says that all those notices, because the time limit for reassessment have got reduced, right? So from 6 years, they have got reduced to 3 years with approval mechanisms. So the agent, the CBDT was under the belief or under the fear that now it may so happen that all the matters may get reopened till 2017-18, and therefore to avoid doing all the reassessment and reopening of the matters, they had given this circular where they said that in case you are, if any of the case is falling under this criteria A, B, C, D, E. So five criteria. If you are falling into this criteria, then only the reassessment is allowed. Otherwise, you can't reopen the matters just because the time limit has got reduced to 5 years, from 6 years to 3 years. Investigation is one. The cases for non-filer management system. So whatever is their internal systems which they have developed through which they are able to get a flags uh, as per the risk profiling criteria. Those are the cases which will be covered. Cases where the information, just a second. Sorry. So cases for cases where the information arises from the survey action requiring action under 148, those will be covered. Cases for of information received by any income tax authority requiring action under 148 with approval of chief commissioner of the income tax concern. So if that is if these are the situations, in that case the reopenings are allowed. So while there have been a lot of reassessment notices which we have received, there can always be a question raised on whether we are getting covered into either of these situations or not. And if not, then you can always question or challenge the validity of the reopening. So that is what the summary of this circular is. Moving ahead, which are the matters which are not covered under the faceless scheme? So taxpayer outreach and taxpayers education, taxpayers facilitation. This was another. Okay, moving ahead, rectifications proceedings, grievance handlings, demand management, recovery proceedings, audit objections, any higher authorities passing an order and that orders has to be given effect to. So 263, 264, prosecutions, compounding, all these things are not going to be done under the faceless assessment scheme right now. So these are beyond that. and they are kept outside those particular faceless schemes. I think now we are coming to the end of the session, and I'll just summarize these two important circulars, important notifications, which describes how the valuation mechanism will play in such kind of transactions. First, it talks about reconstitution of the firm. We all are aware of this particular Finance Act have
we propose to add actually approach.
Okay, going ahead. So basically, it says that the reconstitution of the firm. So now the Finance Act have introduced that in case if there is a reconstitution of the firm, and as a part of
that when
Ashish, is there somebody raising a question, or it is an
36158, those kind of cases, and if they are not rectified,
I have told him personally.
Assessment order is passed.
Sorry, what is happening, Ashish?
Mistakenly, I think someone's audio is getting unmuted. I have told him to mute it.
Okay, no problem.
Yeah, and I'll have a word with him. Yeah. Sorry.
No problem. No problem at all. So now going ahead on this particular reconstitutional matter. So in case if there is a reconstitution into a partnership, and because of that, so reconstitution also includes change in the profit sharing, admission of a partner, or anything. And as a result of this, one partner is taking out the benefit of his capital. In that case, how the tax calculation will be done is what is notified under this particular notification. So it says firm will pay capital gain tax on a revalued asset transfer to partner on reconstitution. Now, let me give you one example. There are three partners. Let's say Mr. Nikhil Joshi A, Ashish, and I are the three partners. Okay, we run this particular firm over a long span of time. Now, what is going to happen is that I decided that I want to move out. Okay, so there will be a revaluation of all the assets, and the assets once are getting revalued, I will be entitled to receive my component, right? So when I'm receiving my component, let's say the revalued component which I am going to receive is 20 rupees. So the firm will pay capital gain tax on revalued asset transfer to partner on reconstitution. So that asset which is going to come to me minus whatever is the cost, that is the first capital gain tax which the firm will have to pay. Now that additional 20, which was a revalued figure, we all are aware of, that will be getting distributed among the partners. So we three of them will take 6 for the time being understanding purpose, 6 rupees individually to their capital account as a revalued profit. Now let's say my capital was 100, my revalued capital is 106. Now let's see if I am withdrawing 110. Okay, so there is a 4 rupees additional which I am withdrawing. So what will happen to that? So the revalued reserve only of the asset transferred will be distributed to the partner that we spoke, that 6 rupees will be distributed. Excess amount paid over capital, which is the 4 rupees which I am talking about, will be taxable under 45(4) as short-term capital gain. So that 4 rupees, which is over and above my revalued capital, will be taxed to the firm under 45(4). Right? We are done till now. Excess payment to partners will be attributable to remaining asset in the proportion. Now let's say if I got that 4 rupees extra. Now there is only remaining partners who is Ashish and Nikhil. Okay. Now this 4 rupees will be kept and it will be allocated to the remaining asset. I took one asset. So let's say, for example, Mumbai office I took over and I took that particular office. Now Delhi office and there's one more office, let's say in Hyderabad. This two office is still with the firm. Now the 4 rupees which I took additionally will be allocated to Delhi and Hyderabad office as an asset. Okay, so that will be allocated to them. So the asset value of that particular Delhi and Hyderabad will increase by 2 rupees, assuming both are having same cost. So it will be increased. Although revalued number allocated to remaining asset is cost, it will be now what will happen to that? So Delhi office, let's say, is having a total value of total value of, let's say, 25. This 2 rupees is getting allocated to it. So that is 27. Delhi office was already getting depreciated. Now, whether I'll be able to depreciate on this additional 2 rupees, the answer is no. You can't depreciate it. You will have to keep it as a part of the cost. Tomorrow or 5 years down the line, if Ashish and Nikhil decides that now we want to sell off the Delhi office. So Delhi office will give a consideration, let's say 50 rupees. So out of 50 rupees, this 2 rupees will get reduced. 48 rupees minus whatever is the WDV, that will be the capital gain, right? So that's how the capital gain calculation will happen. The next point, I think this is the last point of my presentation. In case of a slump sale, now since exchange is also considered as a part of slump sale, so Ashish had one unit, I had one unit, we exchanged. Okay, now because of the exchange, there is no consideration decided. I gave away mine and I took away Ashish. So now what will happen? How do we calculate the capital gain in that case? So this is what the notification is trying. Notification has given a rules on how the calculation should happen. So it says amended section provides that the fair market value of the capital asset transferred shall be deemed to be a consideration. Okay, so Rule 11 UAD provides method of working out the fair market value, which is higher of the following two formula. Formula number 1 is exactly the same formula which is of 11 UA, which is basically calculation of fair market value restricting to the undertaking. So let's say if there are 3 units, then the one which is getting exchanged, that unit will be considered, and that's values 11 UA will apply. The 11 UA formula will apply to that particular unit. Formula number B is where you apply 11 UA for the assets which are classified or which are eligible or which are covered under 11 UA. There are certain assets which are not covered under 11 UA. So in that case, you will have to take a valuation report. Valuer will determine what is the value of that. So Ashish has 5 assets. I am exchanging, I am taking over his unit and I'm giving away my unit to him. Now for me, the consideration which is going to be that what Ashish is going to give. Okay. So it says that Ashish is giving me whatever other unit, that unit has 3 components of assets. One component of assets is basically which is covered under 11 UA. So I'll apply 11 UA, right? There are certain assets on which 11 UA is not applicable because they are not classified under that definition of 11 UA assets classification. It's not covered. So in that particular case, I will appoint a valuer and I'll do the valuation of those assets. That will be added. And 3 is pure monetary consideration. So whatever is the monetary amount which is lying in that particular unit, that will be the third amount. So this total will be considered as a consideration for the purpose of calculation of capital gain. So this is how the whole formula will apply. That is what the rules is trying to say. With this, I think I'm done with my part of the presentation. I'm really happy to take questions on board. Ashish, I think we can open the floor.
Yeah, definitely.
Are there any questions on the chat box?
No, none as of now.
Wonderful.
Members, please feel free to ask any queries or questions related to the topic with the speaker. You may unmute yourself, please. We'll wait for a couple of minutes.
No problem, Ashish. So till that time, can I utilize this with your permission?
Please, why not?
Okay, so till the time questions are raised, if somebody wants to raise it, I just wanted to introduce, there's one WhatsApp group, which there are a lot of chartered accountants who are already a part of that group. We all internally, what we do is whenever we come across something new in our practice, we share it with the members and members can take the benefit of it in a very concise form. So if suppose today I came out with an opinion and I did some studies on that, I'll prepare a concise of it and I'll post it into that group so the members can take the what is the concept behind that is what is being shared in this group. So if any of our members wants to join to this group, then they are happy and welcome to join to this group. The group link is already there at the bottom of the page.
Okay, that's a really nice initiative. Can you send it to me?
I'll share it right now
share
in
it to the
the
members as well, because this won't be accessible by the members.
Just give me a second. I'll just share it in our chat box itself so that people, if they want to, they can take the benefit of it.
That would be great. Yeah.
Just a second.
Good evening, Darshak.
Hi, Snail bhai. How are you?
Fine, fine. How are you? So your presentation is good, and the end of the presentation, the mukwas that you are giving by giving the link of the WhatsApp to everyone, I think is filling the things. So anything that is left here, the group will cover up the things. Great initiative, Darshak.
Thank you very much, Snail bhai.
Members, please feel free to ask any queries or doubts related to the current session.
I think, Ashish, you can also say that you can feel free to ask any question without putting that current into question. I think Darshak will be able to handle anything in direct text. That's not an issue for him.
That would be great as well. Yeah, members can ask their doubts. Yeah.
I think Darshak,
Darshak,
your explanation was too simple for everyone to understand. You don't have any other option to think on it. You have been able to convey the things that no one has any questions, and it has cleared their doubts.
That's the beauty of being online, because members are
Darshak, when I also take sessions, I find this as a common thing that people normally avoid questioning chatters. So as a speaker, it is always interesting. Yeah, finally we have Ajit Bhai. Ajit Bhai's question is there on screen now. I think one.
I'm currently seeing a different situation. What is happening is there is no question coming online, but offline. Then what happens? Then people share it through a WhatsApp message and so and so.
So I have made a practice. Darshak, I have made a practice. Anything comes offline is a paid service. Anything taken online in this sessions is a free service.
Okay.
We have a question of Ajit Bhai, I think, for you. So, if Ashish permit, can I take up the question for Darshak?
please, sir, please.
So, whether payment of TDS 194Q is happening, today is the last date. A practical question has come, Darshak. Any clue?
Whether payment of TDS and the 194Q, I'll need to get
outside
to my own thing. Because
yeah,
whether practically this TDS 194Q payments are being able to happen on portal or not, I won't be able to give an answer.
It's 6 o'clock.
Right. So I think TDS queries started coming up. There is actually a system error. What Devan Pai also has put, no, is also the same thing. There is an error coming. At my office also, we are getting the same error. So I think it's a issue at the software level, IT issue.
There are multiple issues which are there currently at the software level.
The answer remains no, then I think. And we have another one, Darshakji, in cases where there are TCS deductions in the 26AS return is not getting uploaded.
So that is what I said. It's Ashish. It's again the same thing. Return issue that
related to your current software. So
exactly. I think we are on time. 6 o'clock. Darshak has concluded on time. Excellent presentation, Darshak. Before vote of thank you is concluded, I really thank you for taking these efforts to come at Andheri Study Circle and present this paper to all of us. And again, the group members will again be benefited from your WhatsApp group in the coming days, because the efforts that you put in research will always benefit all the members. Thank you for joining here. I think Ashish,
Yeah,
who is taking good comments.
You were able to share that link. It's not visible on the chat box. So
just a second, I'm just trying to do it.
Yeah.
You got it, Ashish?
But I don't think the link is opening. In case if you can share the link over to me or Gaura, and then we can share it with the members. Yeah,
sure.
Thank you once again, Darshak Bhai, and this session made me wealthier, I think, if not anybody else, by exchanging the capital assets to your examples. Thank you, but thank you so much for your time today. And
the benefit of virtual sharing of assets.
Virtual sharing of assets. So I hope our members also would have benefited from this session. And we hope to see you soon again with another set of updates of the income tax.
Sure.
Thank you so much, Darshan. Thank you.
Thank you, Sunil Bhai.
Thank you.
Take care, members.